All right, so welcome, guys, to this lesson. This is going to be an advanced lesson, so it's not going to be your typical lesson per se on price action. This is an advanced price action, and I might potentially add this to the advanced lesson on the Lazarus program. So I was going through. I'm doing essentially the entire month of December as a study because I went on vacation for like a month, so I was not really into a prize action, and I wanted to journal and study the month of December and do some lessons on that. And so I also plan to do some videos as I'm going through the month of December, so you guys can also see how I basically journal and break down prize action and all of that stuff. So this morning I was going through dollar before my Zoom call this morning, and I went back to sorry, essentially dollar and euro dollar. So I'm only working with these two assets and also GBP dollar. So essentially it's three. So I work with three assets to make it easier for me, and I just track it because this is essentially 90% of my trades comes off of either euro dollar or British US dollar. So yeah. So this is the economic calendar from Monday, which is November 29th, going all the way down into December 3rd, which is a Friday. So I'm not really doing anything on Monday or I'm not on slash Tuesday. So I'm only focused on trading from December because I'm assuming that's where I want to start my journaling. So I have a Telegram channel where I just post my journal to there and all of that stuff. So you can also do the same thing. So it's also important to understand that when you're journaling, you need to have your economic calendar because again, especially if you're day trading, you're gonna day trade around when the news actually releases. And it helps you filter out. It helps you mix real time price action and how you would act around news releases. So that's why the first thing I always do is to go look at the calendar and then pair that up with the chart and see what it's saying and use that to then forecast like it's real price action. What I expect the market to do. Now, essentially looking at this, the lesson I want to talk about is intraday scalps. That's the lesson for today. Now, what I typically tell you guys is to assess the market condition. So you want to assess the market condition. Is it high probability market condition or is it low probability market condition? Now, the question is, how do you define a high probability market condition versus a low probability market condition? An high probability market condition has a defined order flow, right? So if it's a bearish order flow, there's a very clear high time frame discount rate that you want to see price reach for, and there's a very clear higher time from premium that price is originating from. That is your bearish order flow. If you have a defined bullish order flow, that means you have a very distinct discount rate that price is coming from, and there's a very clear premium rate that price wants to reach for. So that higher time from push or pull, meaning from premium to discount, creates the bearish order flow, and from discount to premium creates that bullish order flow. If you can make a case for this, if you can make a case for a bearish order flow or a distinct bullish order flow, that is a high probability condition because it creates a one-sided market environment. So now let me explain real quick. The necessary condition for you to have a trade on is that there is a very clear level that price is coming from, and then there's a very clear level that price wants to reach for. Once you have those two factors, it's just a matter of timing your entry to get in sync with order flow. That is a high probability market condition. That is what creates a high probability market condition. During periods where you cannot make a case for either side of order flow, meaning you could make a case that the market wants to reach for a premium order flow, a premium array, or you can make a case that the market wants to reach for a discount array. I typically call this 50-50 market condition. And that is a very low probability market condition on the higher time frame. Now, I'm not talking about lower time frame. I'm talking about higher time frame premise, excuse me, that creates a low probability condition for the lower time frame. So once you spot that type of characteristic on your daily time frame, for example, or your weekly time frame, for example, where you can make the case for both sides of the marketplace, and then you go on your lower time frame, you already have a low probability condition. Now, if your lower time frame is in the consolidation, then that is an extremely low probability environment. Okay, but if your lower time frame is still trending, then that is just a low probability from the higher time frame, but you can still work within that smaller range. Okay, so the first thing, which is always what I tell people, is the first thing is always to profile the risk as a professional, which is the goal, which is what I'm trying to communicate on these conversations and these sessions. As a professional, your first priority is you want to assess risk. You do not want to invest in an extremely risky market condition. You want to be risk averse just like everyone else who invests, they're going to be. And this is why so many institutional traders they actually fail to be consistently profitable. They fail to be consistently profitable because they fail to assess the risk. They don't know when just high probability market condition, they don't know when it's a low probability market condition, they don't have a protocol for a high probability market condition, they just no protocol for a low probability market condition. And you can't just attack the market without a plan. You can't just go into the marketplace and expect that your analysis is going to do the work. Because what a lot of you guys are doing is you're going to the marketplace expecting your knowledge to do all the work. You want your knowledge to do all the work when it comes to analysis. You want the knowledge to do all the work when it comes to risk management, having all of that things, all the plans and protocols and all of that stuff. You're going to definitely miss some very important details if you don't have a checklist to go by when you're on your charts. And that's why you always see me for example, on pictures and on online social media, when I'm going through my laptop, when I'm on the charts, there's always a small little note beside me. That little note beside me is my checklist. So I'm going through my checklist, I'm verifying everything to ensure that I'm not missing out on any information. And then once I've gone through my checklist, I then arrive at a conclusion, I arrive at a decision. And then when I'm doing videos like this, that's why you can always see me give you conditions. If the market does this, I'm going to take this action. If the market does this, this is the action I'm going to take because I already have a plan for anything the market throws at me. Versus you guys, we just jump to the marketplace, you do your analysis, and immediately you have a trade to put on. That's again, it does not work that way. Okay, so I just wanted to put this out there before I go into the analysis. Now, looking at this, we have a weekly, smaller weekly inefficiency, which is this purple line. If I go out to the weekly time frame, I essentially pull that level up from all the way from this. So there's a smaller weekly fair value gap there. The market trades up into. If you were with us, then you would have seen we're talking about this often. And then when the market leaves that weekly inefficiency, look at it creates an inefficiency. So we have a smaller bearish fair value gap at a premium, and we have rejection block plus bullish or a discount for value gap. So I could make the case that because we traded up into this premium, okay, we should be trading lower into discount. I could also make the case that because institutional flow is bullish and we failed to close below these two down candles, which is a bullish shadow block, we can be bullish to then reclaim this weekly inefficiency and then potentially even trade higher to 97.80, which is another die on the weekly time frame. So, see what I'm doing. I already can make a case for both sides of the market. I can make a case for bullishness, which would be the safest option. Why is that going to be the safest option? Well, what does it mean? Order flow. Order flow has been bullish for a while. So why would I want to go against order flow when it's showing me that it is clearly bullish? That is the most likely scenario, bullishness. But there's also potential bearishness because now we've shown response. We've shown that we're respecting a premium rate. So now I can make the case for both sides of the marketplace. What I've just done here is I've created protocols for myself. Is this a high probability market condition? No, it is not. This is a low probability market condition. Why is this a low probability market condition? Because I can create I can create a case for both sides of the market. I can create a case for bullishness, which would be the safest option. But I could easily be wrong and the market goes bearish because the market showing signs that it wants to respect the bearish discount rate. Sorry, the bearish premium rate, which is this bearish value gap. So as a newbie, okay, someone who's new to institutional trading, I mean, you've been doing this for less than a year. What do you do in this type of market environment? What do you in this type of market condition? You either sit this out entirely until you verify order flow, or you stick to high probability intraday scalps. Now, because this is a low probability market condition, does not necessarily mean that there is no trade on. The only trade you can find in these type of market condition is intraday scalping, which is what I want to talk about essentially. There is no chance for a swing trade because we are 50-50 on the hour time from premise. There's no chance for a short term trade because again, there's no clear order flow on the daily. There's very little probability for a day trade. So we're looking for short term trades, meaning our trade is going to be facilitated by intraday or intra-session liquidity draws. Okay, so we can use intraday or intra-session liquidity draws because again, these are small little movements on the grand scheme of things when it comes to the time frame, right? So we can use those small intraday liquidity draws to frame something if we need to put on a trade. Now, look how my plan has adjusted in accordance with analysis versus you, for example, which is going here and you want to place a short-term trade on because, again, uh, I was in a bunch of traders. They were calling the dollar is going to 97.80, but before dollar goes to 97.80, they were so sure that dollar should go down here. And if dollar goes down here, sorry, not here, dollar should go down to its inefficiency. And they said, oh, I want to see dollar go down to its inefficiency first, and then dollar continues going higher. Like that's not the way you analyze the market. Because what they were doing, they were predicting, not reading the tape and making a sound, logical conclusion. Looking at this price action, can we make any case for downside or upside? We can make a case for both. So what do we do when we have a situation? Well, we don't look for anything long term. We don't do anything short term. We do something extremely intersection, intraday. So this is where it leads to intraday price action analysis. So what we can see right here is we've seen price trade up into premium, we see price trade down into discount, which is this bullish order block, and we are respecting that bullish order block. Now, why am I using the open of this daily bullish order block and not this? Well, I'm using the open of this daily bullish order block because current market price action, once I go into lower time frame, is inside of this. Now, if it's within these two, it's inside of this. So it's important to have this reference point, which is the open of this candle for intraday premise. Now, because the market is extremely short term, does not necessarily mean the higher time frame does not hold any ground when it comes to intraday scalping, uh, or extremely short term intercession analysis. Again, and this is what I tell you guys. This is why the higher time frame is extremely important when it comes to your analysis. The higher time frame is still, even in the low market probability environment, even in the short term trade, day trade, intercession trade, the higher time frame will still play a huge important role when it comes to the intercession fluctuations in price because it is around these daily reference points that orders are taking place. It is around these higher time frame reference points that there's dealings around. And that also leads back to the verification of our theory that price is controlled by the commercials and the bigger banks, okay, the central bank essentially. Okay, and they will orchestrate price around these higher time frames, and then the lower time frame is only used to get in sync with these higher time frame fluctuations. So now let's look at what I'm talking about, for example. So we have a premium here, we have a discount here, we have another discount, which is this bullshit block. The open of that bullshit block. So we're using that, and then we can take this down to a lower time frame. Now I have this economic calendar here because typically I only trade New York session. If I'm day trading, especially, I trade only New York session for day trade. Day trades for session trades, New York session. Short-term trades, London session potentially could be incorporated, and also for swing trades. Okay, I don't position trade, so that's out of the equation. All right, so now the first thing we want to find out is their order flow is neutral. Okay, we can make the case for bullish order flow. We can also make the case for bearish order flow. So we don't take any actions until we see very clear, defined clue that the market wants to clearly reach for something. All right, what is it clear? What is it reaching for? Now, the first thing to notice here is we've taken out buy side liquidity on the 1 hour time frame. All right, taking out sell side liquidity. So we took out sell side liquidity here and also here, but extend this out here. Took out any pending sell stops here, any pending sell stops here, and immediately shut up. Taking out the buy side. Okay, so neutralize sell side liquidity. We've neutralized buy side liquidity. Whenever you see situations like this, which this is typically what retail call a whipsaw. So the market just whipsawed around and it's not consolidating. So whenever you see conditions like this, there's a very high probability that the market is going to consolidate a little bit before you see another level of expansion. So uh, most times when you see price action like this, it will consolidate a little bit to build up orders and then continue to expand when both sides of the board is cleared. So this is what we call neutralizing open float. So we've neutralized sell side, any sell side open float, also buy side open float, all neutralized. So now the one is currently profitable, and the market will need to reprice to then build up more liquidity, aka orders, right? So now we're trading to a 1 hour discount, right? We have a range, low to high. That is our range. That is our defined range. Until price breaks out of either the high or the low, this is still our defined range. So this is a range we're going to work within because order flow is neutral. So there is no strong bearish trend. There's no strong bullish trend. So using that logic, because there's no strong bearish trend, there's no strong bullish trend, we're going to say we're going to work within this range because there's going to be more probability that the market will be neutral, aka consolidating. So if it's going to consolidate, then that means it should still stick or it should still trade inside of this range. Because if it breaks either the low or it breaks either high, that becomes a trend market condition, which we don't want to see because again, order flow is neutral, and we just recently cleared both sides of the liquidity, which is sell side liquidity and also buy side liquidity. So using that logic that we want to see order flow stay neutral, we go into that logic wanting to see a confirmation that price wants to respect this as a discount. We don't want to see the market trade through our discounted rate. We want to see the market respect our discounted rate. Now, let's look at the economic calendar, excuse me, and see what news we have right now. So this is 3:30, 15 is 3:15 p.m. This is also set to 3:15 p.m. here. Excuse me. So 3:15 p.m. on your dollar and also 3:15 p.m. on uh DXY. Now the reason why I set it here and I'm using replay tool from there is because I don't want to do any trading until after the 4 p.m. news. Okay, so you can see we had USD news come out 2:15. We had CAD news come out, British pound news come out, and when I was doing my journaling and when I was going back and I was using the replay tool, I started actually from 12. Typically, I start my replay from 12 because that's when New York session typically starts for me. So when I was doing all of that, there was no real significant movement. So I'm like, this is suspect. The fact that we've not seen any significant movement with any of the news releases that came out is suspect to me. And maybe we want to do something in terms of volatility with this news 4 p.m. But because I cannot make a case that we're going to respect this, or I cannot make a case that we're going to trade up into this. I only know that the market's traded down into this if it's bearish and potentially run through this, or if it's bullish, then it has to trade down here and up into this. Now, why am I saying it has to trade down here? Now, you could respect this because, again, this is that daily bullish order block open. So, ideally, I would like to see the market stay here and trade higher. That will verify to me that, okay, maybe we have some type of bullishness. And then I will use other confirmatory tools, excuse me, to verify to me that, okay, maybe we want to reach for this inefficiency. But if we do trade through this, then I'm allowing for a run down to closing on this inefficiency because that is still within the daily bullish order block. So I'm giving leeway to this and saying, okay, you could do anything you want, but I'm not going to take any action because I don't want to jump in price early and then be in drawdown, especially with news coming out or coming up. Now, if we were trading around here, and it was about to be news released, I will be looking to actively want to go long if order flow higher time frame order flow was bullish. But because higher time frame order flow was neutral, I will be looking for the market to go long, but I would not execute on that trade. I would look for the market to go long and break some kind of lower time frame structure to verify to me that okay, this is now bullish. We're now offering buy side liquidity before I then take any action, if that makes sense. Okay. All right, so now let's. This is essentially what I was thinking to myself when I was journaling this, and that was my thought process. So now we have news coming up by 4 p.m., which is essentially 4 to 5 minutes from now. So let's see what this market does. So I'd like to see if we can respect this because we traded down through this rejection block and we've taken out sell liquidity. It will make sense to trade lower down here because there's a pool of sell liquidity here. And we can trade lower through that. That is sell liquidity being neutralized. And because we have neutral, order flow is neutral on our time frame. So if I see liquidity being neutralized, I could make a case for bullishness. Okay, anyone who was going short is now taken out. Anyone who was long initially has no positions on. So that is the perfect condition for me to want to go long. Okay, so I'm thinking like the central banks, neutralizing liquidity. So now let's see. So the news comes up around 4. So what I want to do is I want to put a vertical line around 4 so I know around the time I should begin to anticipate some kind of action. All right, so you can see just before 4 p.m., we reached down into our discount rate, which is we're closing in on that inefficiency on the 15 time frame. Now let's look at what euro dollar is doing. Now the first thing I did was to paint lipstick on the price action on euro dollar, and you can see all of this up candle is a 1 hour bear shuttle block. So again, I'll go out to the 1 hour time frame. You can see that is a 1 hour bear shuttle block. Now again, just like euro dollar, I could also make the case for both sides of the marketplace when it comes to uh sorry, just like this, so I could make a case for both sides of the marketplace when it comes to euro dollar and say it could go bullish. I could also say it could go bearish. Okay, but the first thing is we traded down into a discount objective, which is a daily. So I should make this red. I make my weekly levels red. So I'm gonna make this red. Also gonna make this red. So we've traded into uh a weekly objective, which is this daily BC. So this is a daily BC. It's a buy side imbalance, sell side efficiency. Okay, so that is a discount. That's an higher time from discount rate. Okay, so this is a sorry, not daily. This is a weekly BC. That is a discount objective. Okay, so if you were on the live sessions, you would have heard us calling uh this market lower all the way down to this. So we trade down there. The question is, what do we do next? Now that we've reached another time frame target, what is going to happen next? Right? So whenever we reach another time frame target, there's three potential that price could do, or there's three things or options that the market could take. The market could either consolidate and build up new orders, aka liquidity. The market can continue to expand in the direction of previous order flow. In this example, will be bearish, and we can see the market continue to expand through bearishness, or the market could reverse altogether. Now, the thing is, we don't know for certain what the market wants to do here. We need the market to show us. And this is typically when I day trade. Now, if I have an hour time frame drawn liquidity that I think the market wants to reach for, I will short term trade, I will swing trade potentially, I would day trade, and all of those are all fine because I have a long term target, which is this. And you would have seen me take all sorts of entries: day trade, short term trade, long term trade, scalp, all of that entry. During trending market condition like this, where I can make a case for a one sided market potential, I could do all sorts of trade. And that's where you see me make lots of money and I could do 200% ROI in like a week or something because I know where the market is reaching for. I can easily jump on the sheep and ride out uh, the wave. But now, when we get to these targets, that's where, from my own experience, that's where I struggle. So, what do I do to combat this? Because that's where I take majority of my losses. Okay, because the market could reverse from there, or the market could continue trading lower, or the market could go into the consolidation. So what I typically do is I don't short swing trade, I don't swing trade. I will mostly scalp and sometimes day trade. So for mostly 1 minute, 5 minute time frame, and sometimes 15 minute time frame when I can make a case for a one-sided condition on the 1 hour chart. Okay, so again, reverse. So not reverse. Excuse me. Go back the last 30 seconds to 1 minute of what I just said. Try to understand what I'm saying. It's going to help you massively in your analysis. This is how I adapt. And that's what I try to teach. I try to teach flexibility. You gotta be very flexible as a trader so you can easily adapt to any condition the market is throwing at your face. And that is how I adapt. So I don't just jump in there anticipating the market to jump all the way down to this. You never even say, oh, because of trade down here, the market is going to go down to this. Or because of trade down here, the market is going to reverse. Because I truly don't know. And no one truly knows. Nobody, no person knows what the market does whenever we get to a target. That is always a speculation. That is always speculative. So because of that, I simply stick to a lower time frame speculation or intraday scalps, day trading until the our time frame verifies to me that there's a new order flow in play or we're resuming previous order flow. That's all I'm looking for. So with that being said, I could make a case for both sides of the marketplace. Now go down to a daily time frame because we've traded down to that weekly, sorry, discount array, and we've traded back up into that weekly BPR. That's a balanced price range. This is a weekly balanced price range. Okay, because we've traded up into that. Okay, so essentially it's nothing. Now, if we were still around here, and we've not traded up into this, I could still say, okay, I will be looking for day trading longs or intra-session scalp longs because we trade down into a discount and we could be reaching for a premium before we even resume lower. But we've already done that here. We traded down into this small little daily fair value gap, and we traded up into a weekly bearish balance price range, also running out a rejection block with neutralized liquidity. So I cannot make a case for bullishness. Neither can I make a case for bearishness. Now, the most ideal would be to see continued downside. But we could easily still retrace up in this and see downside, or we could easily retrace up in this, or we could reverse it altogether. I don't know. So what do I do then? I stick to a day trade. I look for a potential one-sidedness on the lower time frame, and I speculate on that. Okay, going to a lower time frame objective. We can see where we clear out that liquidity and where we trade down to that daily inefficiency. So now let me delineate that daily inefficiency. We're going to use a zone. That is a daily inefficiency here, daily fair value gap. And this is the daily inside the daily bull shadow block. Now remember I talked about hyperliquidity order blocks. Hyperliquidity order blocks are the blocks with inefficiencies lying around them. And this is an hyperability bull shadow block. That's why I said I would have been looking for verification to go along all the way up into this. Now we've traded down there and we've seen a response. Now we've traded up into we have the market trade up into this weekly BPR plus a daily inefficiency. We've got very close to there, but did not quite get there before we just sold off and then retrace all the way back up into the upside. Okay, so now what I'm looking for is there any potential draw on liquidity? We do have one. We have this bear shadow block. If we want to be bearish, we want to see the market respect this bear shadow block. And what is resting inside that bear shadow block? We have a 15-minute bounce price range, which I'll show you shortly when we get to the 15-minute time frame. And also we have an inefficiency on the downside on the 15-minute time frame. So even though this is an extremely low probability condition, and again, you don't want to trade inside these type of conditions, but just as a lesson to learn, okay, or as a practice, uh, when it's a low probability environment and when the market is consolidating, typically you will get reclaimed reference points. What I just said is extremely important. It's a mind blowing fact. What do I mean by reclaimed reference points? Oftentimes, the market will trade to an inefficiency or a balanced price range more than once, or the market will trade to another block more than once, or a breaking block more than once, and you have to be aware of this. Reclaimed reference points typically are very frequent in consolidating market conditions. Okay, and this is a reclaimed balanced price range. Okay, so this is a reclaimed balanced price range. So it's a reclaimed balanced price range because we traded up into that the first time. Look at the way the market responds to this. This is the we have a buy side inefficiency, buy side balance, sell side inefficiency. The market bounces that here. Remember, balance price ranges act as natural support and resistance to price. So once price trades up into that, we're looking for a response. Look at what the market does there. The moment we trade up into that, look at the wick. We trade down there. The market is showing us that he wants to respect this reference point. Okay, so because of that, leading up to the news, we're seeing the market trade higher. So where do we think the market could potentially reach for? It could reach for this same balanced price range. Now, where do we get our bias wrong? If we see the market trade above this bearish order block, then most likely we're wrong in saying maybe the market wants to trade down and run out this liquidity and trade back down into this inefficiency and completely close out this inefficiency. But we're looking for proof that the market wants to be bearish or that the market wants to be bullish. Now, at the time when this is 3:55 p.m., let's look at what your US dollar is doing consequentially. So we want to first put the timer to 4 p.m. because that's where we have a news release. And remember, we're not doing any trading before our news release. We want to see the aftermath of our news release before we take any action, right? First up, we have rejection block, which is a premium array. That's where the bulk of liquidity will be at. So again, it will be an advantage for us to see the market run through this rejection block because that is showing us that we're neutralizing any short inside of this if we want to be a seller inside this market. So now we run up into that rejection block and we reject. Okay. We run up into the rejection block, we reject. On dollar, we run down into that inefficiency. Now, watch how dollar trades lower than the low traded 9 a.m., but your dollar fails to run higher. That is SMT divergence. That is correlated asset divergence. If dollar is running lower than its low 9 a.m., your dollar is supposed to do the same thing because you're oppositely correlated assets. But your dollar is not doing that. But the XY is doing that. That is one confirmation. Now, again, remember, we don't have a defined order flow. We don't have a defined higher time from order flow. So because we don't have a defined higher time from order flow, we're not going to buy this. But if higher time from order flow was bullish, we would have bought this. We would have been buying this because this is a very clear bullish indication. Discount array, the market's trading down to a discount array, add a news release with correlated asset divergence with an established higher time frame bullish order flow. I would have been going long there. But because higher time frame order flow is neutral, again, look at how this is playing into my intraday analysis. Because higher time frame order flow is neutral, I would not go long here. I'm looking for response. Does the market respond to my analysis and confirm to me that it is bullish? If the market does confirm to me, then I can pull the trigger, although with half my standard risk. Okay? Why am I using half my standard risk? Because again, it's still a low probability market condition. Even though this is a high probability scalp, it's still within a low probability market condition. Okay, so going back into this. Now let's see the response on dollar. So you can see we're starting to trade up. This is the last swing guy on the 5 minute time frame prior to us running to our discount array. We've broken market structure here. So we break market structure here. That's all I need to verify. Go on euro dollar. So this is 1620. So we want to see 1620 on euro dollars. Let's see 1620. So this is 1620 on euro dollar, and we trade up there. Okay. So again, going down to the 15-minute time frame. Now, one of our tools to confirm is obviously smart money or correlated asset divergence, which we have here. What can you also see here? Remember, we still have a target drawn liquidity here. This is our target liquidity draw. But what is confirming to us that we're bullish? Market maker buy model. So we have a market maker sell model here, which is reversal, low risk sell, reaccumulation, run down to support. Then this is a potential low risk buy. Okay. Same thing on euro dollar. Reversal, low risk buy, reaccumulation, reversal, smart money reversal, a potential low risk sell with our first objective being this. Even though our ultimate drawn liquidity is going to be this inefficiency, we want to say closer to this inefficiency, but our first objective is this old low because that's where immediate liquidity, sell side liquidity will be resting. So I'm going to tag this sell side liquidity. So what I'm doing right here is I'm confirming. I'm not just jumping. I'm using different tools to confirm, different intraday tools to confirm my bias. Okay, so you can see the market trades up, but does not take out the side, trades back up into that balanced price range on the 15-minute time frame, which is a reclaimed balanced price range inside of a 1 hour bear shadow block. Okay, this is the 1 hour bear shadow block. That's why we're looking for shorts there. Inside a 1 hour bear shadow block with a 15-minute balanced price range, with a market maker sell model or buy model to sell model with a correlated asset divergence, plus we've passed our news release. That's a short. So if I was taking this setup, we have a smaller inefficiency here. This is a change in state of delivery. I've talked about this on multiple videos on the Lazarus program, intraday change state of delivery. So once I see this, because again, once the market trades up there, I'm looking for this type of response. So once I see this, that is intraday change state of delivery, and I will go short the moment we trade up into this inefficiency, and my stop is going to go back up above this high. Specifically, we'll go back above this because I don't want to see the market trade up above the body of the candle. But because we are in a consolidated market condition, we could easily have slippage. I think I've discussed slippages before. So we can have slippage, and I want my stop to be here. My stop is going to be there, and my first uh, target will be this old low, the rejection block on the 5-minute time frame, and my target two would be this is an hypothetical. It's not a live trade, an hypothetical. And my target two would be to see a close of this target driven liquidity. So that would have been set up. Now again, as we trade up here, we have a daily bullish order block open with an inefficiency. So I want to see the market trade down here. That is what assures me that the market should at least trade down here before it continues going up and not just keep going up because we have a blended of an higher time frame array. Look at the response there initially. Market trades down there, we have a response, so that is a very valid level. So I want to see the market trade down there, and as the market trades down to that daily, this is a daily bullish block open with a 5-minute inefficiency. As the market trades down there, I want to see your dollar trade up into my level and not trade above the side and sell short. Okay, so let's go. Dollar trades down there into our inefficiency, not up the zone. So this is zone of our inefficiency. I want to see response from price from there and see a run for this liquidity because that's where anyone who was short at the breakout of this, that's where you're gonna have your stop loss placed at. So that's gonna be the first target, and then obviously this is gonna be target two, that inefficiency, because the algo should be repricing to levels of inefficient pricings. So there I have my setup. The market trades up into there. I have a little bit of a drawdown, which is fine because it's still inside of a range where I'll be looking for a short, so it's still fine. I want to see the market start to trade up. This is the low risk buy portion of the market model. As soon as the market trades back down into this bullish order block, the moment we trade above this, I'm looking for upside. If the market potentially trades back down into this, I want to see the market trade up. That's what I'm looking for. Okay, so I don't think we really got down into this. Trading down into this bullish order block. Okay, and we should be seeing response from the market higher. We've seen that. So low risk buy, reaccumulation, another leg of reaccumulation here. That will be another leg of reaccumulation here. Now, what about right here? We have a consolidation. Market leaves that consolidation with a bullish order block. So ideally, we want to see the market trade down to this bullish order block and respond and offer us bullishness. Now, the market trades down to this bullish order block, gives us a little bit of bullishness, trades lower, still within this bullish order block. Let's see what it does if it gives us bullishness. And it does give us bullishness. Trades back down, gives us bullishness. So I extend the entire range of the bullish order block. What was the market doing here? Reaccumulating. Again, this is the market make a sell model to a buy model. Low risk buy inside of here. That's what we want to do your trade. If you miss a chance to get in here, you're looking to get in sync here. Now, you might have missed a chance to buy at the order block, but you have another opportunity to buy here. Okay, buy or your order block looking for a run again above this high. Same thing here on your dollar, right? So the market sells off. We have a small little inefficiency there. We want to see a response. So whenever you're bearish, you want to see whenever you create inefficiencies, the moment the market immediately trades back to your inefficiency, you want to see a response. You want to see the market respect that. That is verification of order flow. This is what I call verification of order flow. You want to see these type of inefficiencies being created. If you are bearish, what verifies that you're on the right side of the marketplace? That is these type of conditions. You want to see the market create CVs. If you're bearish, if you're bullish, you want to see the market create VCs. And once it trades back, immediately rebalances that VC, you want to see response to the upside. That verifies that you're on the right side of the marketplace. And same thing here. Question is, why don't I want to see the market trade up into this? Why do I want to see the market trade up into this? Because it ties back to this level of reaccumulation, right? I want to see the market reaccumulate new shorts at the previous level of longs that was accumulated. That is how typically the market maker model works. And that's why we pair up the left side of the curve to the right side of the curve. So inside of this down candle, that's what I'm looking to do trades. But if I use this inefficiency, it essentially is taking me almost outside this down candle where we had a previous accumulation. And that's why I'm using this. I'm opting for this instead of this. All right, so let's see what the market does. It trades up into that, respects that, and what we're looking for is once the market trade through the rejection block, and our objective is done. We have a smaller inefficiency here with a bear shuttle block. Extend this out. Market trades up into that. Once the market trades up into that, we want to see a response short. So if I miss the chance to sell short here, to sell short here, I will go short here, and my stop will be above this high. That is extremely high probability scalp. Now let's see if we get our target. Taking a little bit of time, still trades back up there, never trades above this high, so still valid to me. Now, to be honest, I would not take this trade here because it is a Wednesday and it is outside my kill zone. I only trade outside kill zones on Thursdays going to Friday. So I will talk about this on another video for day trading. But if this was New York session, active New York session, I would have been taking this trade, and I would not be worried about this. But let's keep going. And I just want to see the market trade work through this. And there goes your lesson. So hopefully you enjoyed this lesson, and I know I took a while, almost 44 minutes. So enjoy the lesson, and I'll see you in the next one. Be safe.